You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
This Week in Futures Options is brought to you by QuikStrike, options pricing and analysis software. QuikStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuikStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuikStrike is the perfect addition to your trading toolkit. Learn more about QuikStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuikStrike1. That's QuikStrike1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications.
All right, everybody. That music means it's time for TWIFO. This Week in Futures Options, a program here on the old Options Insider Radio Network where we break down all of the hot products and interesting trades and unusual activity in the world of futures options. So the other side of the fence, maybe your crude oils, your golds, your soybeans, your lean hogs, whatever is lighting it up this week in the world of futures options. And you guys know how to find us, of course. Easiest place to get all the archives of this program, the mothership, theoptionsinsider.com. Click on TWIFO on the link on the right there. This Week in Futures Options will take you to all the archives. You can always find us on all your favorite platforms as well: iTunes, TuneIn, Stitcher, iHeartRadio, all that stuff. But be aware that some of those third-party platforms will limit you to maybe the most recent 50 episodes or so. That should be enough for most of you, but if for some reason you want to go back and maybe check out something in the dark ages of the show, it may not be up there. I think for TWIFO we should be covered, though. And if you want to get everything, of course, the website's the easiest place to get that, or, of course, via our mobile app, available for iOS, Android, and the beloved Fire OS. Just search for Options Insider Radio Network if you want to do the whole thing, and you'll find the app right there, and you'll have access to everything. And, of course, however you listen, including to those hardy souls amongst you who are tearing yourself away from all of the Election Day coverage, to join us live, you can do that every Friday, 1:30 p.m. Central via Mixlr, MIXLR. So if you follow us on social media, we tweet out the link. If you've ever found it before or bookmarked it, it's the same link every week. You can also follow us via that service, via Mixlr itself, and they'll notify you the second we go live. So welcome to the hardy souls out there who just had your fill, couldn't take any more election coverage, and turned to us instead. We'll do our darndest to fulfill that duty for you. And joining me on the old program today, starting off with my usual cohort, my partner in all things futures options crime, Mr. Nick Howard, the founder of Bantix Technologies and creator of a little platform we like to use around here quite a bit called QuikStrike. Mr. Nick, welcome back to TWIFO, sir.
Hey, man. Good to be back. Glad to have Blue on board today.
Yeah, it should be fun because we are also joined in the CME hot seat this week, listeners, by our old friend of the network, first timer on this program, though, Mr. Blue Putnam, the senior economist over there at CME Group. Blue, welcome to TWIFO for the first time, and you also have the distinct privilege of being the first actual CME representative to jump into the CME group hot seat here. Last week we had John Nelson from Applied Research. So welcome, Blue, and congratulations on this historic honor, certainly the capping achievement in your long and storied career.
Oh, thank you very much. Appreciate it.
All right, let's dive right into it. Blue is joining us today because it is a bit of not just an historic day for him with this milestone, but of course a historic day for the country and indeed for the markets. And we're not going to leave political leanings aside. Obviously, we don't do that here. We're just going to talk about the impact on this. And of course, it is Inauguration Day here in the States. And it has been an interesting one to watch going into this election, then of course, and the tumult we saw thereafter. Then of course, leading into Inauguration Day, we saw some volatility creeping into a handful of products, of course, the broad equities, but also some interesting developments out there in a lot of products, including the WTI Brent battle that's been going on out there, that spread battle. We've been highlighting that quite a bit on the show lately. We'll get to that in a little bit, but that's been a hot topic as well. But let's start off looking back, maybe looking forward, I should say, really, at kind of the broad impact that some of these type of historic days and like inaugurations and elections really have on the markets. I know, Blue, you and your team over there spend a lot of time researching this type of thing. So what is your take on what we're seeing? We saw the market kind of keeping their powder dry a little bit ahead of inauguration today, not really sure what they're going to get out of Trump. And then once the speech was done, maybe a little bit more fiery than people expected, but still the market kind of shrugged. It's kind of an interesting time to be watching this, and expectations for the future across a broad range of products are kind of up in the air right now. So what is your take on this very interesting time and the impact of inaugurations and elections in general?
Well, we came out of the election with a very strong move in equities upward, and then it's really stopped out in the last couple of weeks. It's just plateaued. As people now realizing the White House, the Senate, the House of Representatives, it's all in Republican hands. Now they've got to actually govern, and the devil's going to be in the details. So the markets are going to be cautious as they wait for details on a whole wide variety of issues. So we're done with the promises, and now we're on to the legislative move. So I think we're going to see a little more uncertainty over the next couple of months, which suggests, the use of options and other tools like that for managing this kind of risk as these details unfold.
And Nick, maybe same questions for you before we get into the specifics of some of the products. Obviously, it is an unusual day, a historic day, a big change of the guard. We've been doing this network now for 10 years, so we've seen a few inaugurations come and go, but it's very rare when we see one like this, where we see not just a president taking his second term in office, but really a new administration coming in, and one that is in many ways the polar opposite to the previous administration. So the winds of change are in the air. I'm just curious, your thoughts, general 10,000-foot perspective before we dive on into the products as a whole.
Well, again, I'm not such a political character, so to speak, but I think what you saw, at least after the election, and again now, you see sort of an initial interest in what's going on. You see people tuning in today that you typically wouldn't see watching such an event, and sort of reacting to what's going on. Just politically in our government for the first time in a long time, right? But what I would tend to think is that, we're going to see, I would agree, we're going to see increased volatility, which is never a bad thing. I think the markets want the volatility, and I really believe any way that they can get that volatility, they'll take it. So, it's probably going to be somewhat of a roller coaster right now from a standpoint of people will always be hanging in every word that gets spoken and sort of reacting accordingly. And I think we saw, and we'll talk about it a little bit with that WTI Brent spread, I think we saw some of that same type of reaction based on just statements that are counter to what the people believe happened prior in the market. So, I just look for more volatility, which is good for all of us involved on the radio show, as well as for all the participants in the products that use anything on the CME group. So I'm looking forward to hearing some of the rhetoric from the actual president. I think that's been the thing everybody's been waiting for. It's been always the run-up to the inauguration, and now that President Obama is out of the office and we have President Trump, As odd as that might sound to say, it'll be a real telling from this point forward. That first 100 days is really going to mean something even more this time.
You're right, a lot to see, and a different era now too. Of course, we have the immediacy of the president actually tweeting his thoughts as he thinks them. So a little bit more maybe immediate impact than we've seen. I know in the last administration, when Obama came to office, the big debate was, should he be able to keep his BlackBerry? Is that even appropriate for a president to have access to such a thing? And now we have a president who's literally tweeting. So a different world entirely. Speaking of which, here I forgot to mention at the top of the show, if you'd like to follow along with the reports that Nick and I and Blue are going to be talking about here on the show, you can do that yourself live via the show or after the fact. If you listen to the podcast, however you listen, head on over to cmegroup.com/twio. Not Twifo. Blue, you have to use your pull over there to get them to add the F over there. They call, I guess, everything at CME Group, when you're talking options, is a futures option, right, Blue? So they don't put the F on there. But for us, it's This Week in Futures Options. Over there, it's Twio, This Week in Options. Do that, and you can follow along with all the reports we're going to talk about right now, including this one. You know, Nick, I think we have to give ourselves a little bit of a pat on the back here because you and I were clearly first to the party here on the old WTI Brent kind of battle back and forth. We've been talking about this for some time here on Twifo, and now we're seeing a lot of the broad financial media catching up. Bloomberg and others having a lot of big articles this week, including the Bloomberg piece saying Trump's remarks seen as deflating millions in oil options trades. This is, of course, what we've been talking about for a while. A lot of people have been speculating on the outcome of this overseas tax brouhaha and how that will affect, of course, that relatively rigid, except for a certain period, spread between WTI and Brent, and we've seen a lot of movement in that spread as a result, and a lot of activity lighting it up. We talked last week about how there was a lot of well-timed options activity on the spread, and a lot of well-timed activity in the spread itself. And I know, Nick, you've been watching this really closely this week as well. So first off, kudos to us and indeed to you for highlighting a lot of this first. We get first privileges on this one. And then what's been catching your eye this week?
Well, yeah, we brought it up, I think, after that initial Friday where the trade occurred, and that was back in December. I think December 16th is the first time we saw open interest change back there, and that was way out. And I think what caught us most by surprise was the fact that how far out the trade was out in the December 2018 contract. So as far as this week goes, what we saw from that was interesting was the fact that, you know, the spread had traded up to almost flat on January 11th. Okay, so that's last week or a little bit late in the week prior. When we traded off this week after the remarks, the president's remarks that were reported in Bloomberg. So you saw immediate reaction to that, but we did steady off. So prior to trading up to almost even, we were trading at about the same level we are trading right now. So, you know, the market digested those, but I still think it's sort of thinking that it's going to be around this parity level. So that's really what we're going to watch here. And if you take a look and like we have been all along with the show, and we take a look and use open interest as an indication of whether people are getting in and out of a market, that type of thing, we didn't see much of a change in open interest this week at all, outside of maybe a loss of 150 contracts in the parity strike out in December and maybe 50 contracts in the June strike, but that was counterbalanced with even more openings earlier in the week. So I think what we want to do is watch this spread and see how it reacts to the news. I think long term, the part that's gonna catch our eye the most is out on the curve, out in that 2018, mid to late 2018. That's where the crossover is going to be, where WTI is going to become rich to Brent. If we start to see that spread tighten as we get closer, that's when the trade will get really interesting, because if you got players that were willing, and when you did the premium calculation on those options like we did a few weeks back, those were massive amounts of money. And those spreads they started trading at about 20 cents or $200, right? 0.2 ticks or whatever, and then it's $1,000 per, so about $200, and they traded all the way up. I think last week we talked about it to $1.60 plus. So you went from $200 to $1,600. So there was a real appreciation on that trade. And then what that trade facilitated people taking bets a little bit closer on the term structure. So we started to see trades happen in the June 2018 contract, and typically that's what you see in the crude contracts. You see a lot of action in the first year, and then in the second year you get a summer and a June contract, and then a December contract where most of the next year's trade occurs, and that you can go out and look in the term structure and see that that's generally where the open interest resides. So still looks, when you look at the open interest on this product, you're going to see most of the open interest is out of the money strikes, meaning that there are still people's sentiment that this spread is going to tighten further, and we saw that not only in the parity strike, but we saw stuff trade up to almost +2, or we saw the +2 strike trade. So I think that the general sentiment in the market is that, rhetoric aside, that this spread is going to tighten and WTI might overtake Brent in the long run.
Yeah, it's interesting to look at the fundamentals that are kind of causing that move out the 18 months, 2-year kind of thing, because what we've got is a real realization of what's going on in the shale oil business, because, shale oil wells are not like the traditional oil well. You drill in the Gulf of Mexico, you're going to get a little bit of oil for the next 30 years. Shale oil wells finish a lot faster. It can, they can run that well for a year, 2 years, and then they're done. And so as you're looking at, how are producers going to react to that, they're going to shift their risk management behavior so that when they're putting on a new shale rig, they're going to be hedging out that 18 months or so. The 18 to 24 months is going to be the sweet spot. And that's going to really change, and it's already started to change, the dynamics of how we see open interest develop along the maturity curve. And it's going to be quite fascinating to watch. It also means that the shale oil producers can really behave differently than they did 5 or 10 years. Well, they weren't even around 10 years ago, but they can, if there's a spike in the price of oil upward, they can put their hedges on and then go get the rigs. They don't have to wait to drill the wells to do the risk management. So the dynamics that are out there 18 months, 2 years from now are going to be very, very different than what we used to see in the trading of the futures and options.
Yeah, it has been a fascinating area to watch. I know you guys are putting out a lot of research on crude over there, your team Blue, including Eric Norland, the other member of your research team over there, writing a paper called Oil Will Rising U.S. Output Stifle Post OPEC Gains. Check it out over there on cmegroup.com. Just search for that title, and you will find it as well. If you are, like a lot of our listeners, you want to dive deep into a lot of the structural mechanics underpinning a lot of this options activity we're going to break down right now, that's a good place to start. And moving on over into the big mothership, WTI options. This has been an interesting area to watch, as kind of Blue alluded to there earlier. As this product, not so much this week, but in the past, has inexorably creeped higher, where sometime in the near future may get back to those levels where you're right, the shale oil starts to come online a little bit more. It becomes a little bit more viable from a production perspective. You hear a lot of different argument about what that price point is. It depends on the well and where it is and everything else, but somewhere a little bit higher than where we are now. But if we get into that range, you're right, and we'll bring a lot of other players back online. They can lock in hedges at some interesting levels, and we'll be interesting to see how that changes and impacts open interest going forward. One thing it probably won't do is still continue to answer that mystery as to why so much of the activity is in the front month, but not in the weeklies, which is happening yet again this week out here in the big WT options, with the March front month doing about nearly 60% of the volume out here. Another pretty heavy week. Open interest up about 5.5% this week, about 110,000 contracts. Even though the futures net on the week, we had a little bit of vacillation, net pretty much unched on the week, still pretty much hovering where they were at and around this time last week. And if you're asking us, as all of you are wont to do, what was the number one strike with the bullet out here? Well, people are always asking us, is it the upside calls? Is it out of the money puts? Well, it seems like the puts are leading the charge again this week with a lot of opening paper out here. It was the March 50 puts, yet again, the 50 strike winning the battle with about 27,000 contracts going up this week, including a good chunk on Wednesday, about 10,000, 7,000 on Tuesday, and about 6,000 on Thursday. Of course, the market's closed here on Monday this week, so a truncated trading week out here. And a lot of that paper opening, including a good chunk of that paper on Wednesday. So people coming out here and perhaps establishing new positions out here on that front month 50 put QuikStrike. So perhaps a little bit of hedging here, perhaps expecting maybe a little bit of a retracement post-Trump. We shall see. Then, of course, there's never the calls out here these days, at least in WTI. Never too far behind. That's the case again this week with the double calls, the 55 calls. Also lightened up this week, taking the number 2 spot with about 21,000 contracts overall. Again, a lot of paper on Wednesday, about 8,300 of that 21,000 coming up on that week. A good chunk of that opening as well. So if people always ask me, what risk reversal is kind of in play out there right now, looks like it's the 50-55 out there in March. Very tight. People making a tight risk reversal / strangle around where that at the money is trading. Then, of course, drops off a bit to number 3, which is, of course, the 49 put out there with about 16,000 and change. So it still puts the order of the day. One of the interesting things, and Nick, you and I have talked about this before and kind of talked about this a little bit before the show as well, is from a volatility perspective, what we've seen out there in crude. It does seem like these days, after having spent the better part of the last year having a nice floor around a nice level, depending on how you measure it, implied out there in WTI at the money, somewhere around that, 30 or so, 35 level, a little bit higher. These days, it's kind of just vacillating well shy of that. And it seems like crude vol, particularly out there in the front month, just can't get out of its own way these days. It's kind of relatively unched this week, but any people who had any hopes of a little bit of a spike in crude volatility, maybe a little bit of return for some love for some long premium traders, not so much the case this week. Some interesting developments out there, though, from a skew perspective. I'll let you break that down because I know you are the keeper of the keys when it comes to all things quick skew. So what's catching your eye out there from a WTI quick skew perspective, as well as anything else catching your eye out there this week?
Oh no, like we try to mention every week, the volatility is definitely going to react. It's reacting to the moves in the market, right? So we saw some interim moves up as the market traded down a little bit, but then once the market realized that we weren't going to really follow through on that, volatility came off, and now we're steady again. So it's we talk about it all the time, and we always say, are we copping out when we're mentioning it? But we have a range. There's a range set here, and until there's some real news, and I have a question for Blue then too that maybe he can help us with, because we're always sort of asking that question. But until we sort of establish a new range here, I think volatility is going to continue to sort of maybe have these little bubbles up, but it's not going to go anywhere right away. I mean, we're in this 50 to 55 range, and you saw this week even we started to trade lower, a decent percent from a move within the day toward that 50 strike. But once the market realized it wasn't going to go much further, it kind of ground its way back up to where it is today, and the volatility came off again, or was generally pretty flat. So what does that mean? I mean, I think there's still a reaction to the downside on this market, right? So we see vol get a little bit bid. It goes up its vol skew curve. That's why we see a little bit of the bid, on top of the fact that that's kind of the direction that I think people are trying to push it, since we didn't get the move that we expected on the whole OPEC agreement. So what's that done? So I think the last couple of shows we saw where skew, the 25 delta risk reversal, call minus put, got a little bit more positive, meaning I think the calls caught up a little bit to the puts in terms of volatility. Calls were still cheap to the at the money, puts were rich. So that's the difference with the quick skew versus the regular skew we talk about, with richness or cheapness to the at the money. But this week we saw that there was a significant move back where the calls came off in volatility and the puts got slightly bid. So not only did we see the skew widen more negatively, but we saw the puts move away from the at the money in terms of volatility level, and the puts move higher away from it. So, we have that we like to say the slash from the top left to the bottom right in terms of the way the shape of the curve is formed. And generally speaking, as we start to get inside this 30-day range, we've seen where that starts to balance off a little bit inside this 30-day as we start to move toward this 3 weeks and that type of thing. But we saw it go a little bit negative here. So I think there's still a bent towards the downside here for the market in terms of which way it wants to go from the bid on the puts. But we're not seeing the same sort of like normalization of the skew that we would as we move inside the 30-day range. And the other thing to keep in mind, there's a new report out there under the open interest profile tool. If you go to the summary menu item next to the expirations and you pick the table view for the open interest, you can start to see we break it down by in the money, out of the money, and at the money for each expiration, and let you total it up across different whatever selections that you make. But But the reason that we put this one out here was so you can get an idea of sort of what the balance was within each expiration. Because, we see the open interest, and you can look at the charts and stuff in terms of the bar charts to see the, which way it's tilting. But when you start to look at how much is at the money, how much is out of the money, that kind of thing, you see that there's a pretty decent, and it's probably pretty typical that you're going to see the out of the monies be more heavily weighted towards the other ones. But also, when you see a market move towards some level, you'll see that the at the monies will take over in terms of the amount, the percent amount for within that given expiration. But we see a pretty balanced here, March, April, and June, where we have most of the out of the money open interest is in the out of the money. So we'll take a look at that, and we'll keep an eye on the quick skew numbers to see how we think the market's going to react going forward here. But Blue, I had a question, and I don't know if there's a reason for this or not, but is there an explanation as to why, like when you go out into the 2018 expirations, that you only see significant activity in June and December?
No, I think there's not a good explanation, but essentially you want to go where the liquidity is. And if the liquidity starts to build up in those June and Decembers, then it's going to attract people looking out for the longer term. And so those 6 months breaks are very convenient items to look for. But what people are really looking at the fundamental level are where's going to be your sources of surprise that could take you out of this trading range. And by definition, a surprise means we don't think it's going to happen. But you're still looking at certain areas, and you're looking at the shale oil production, you're looking at the inventories, and you're looking at OPEC. Can this deal hold together? And all of these things are probably going to take several months to kind of play out. But we're pretty sure that U.S. production is on the rise again at these prices, with rig count going up. And that's in contrast to, how much discipline does OPEC really have? If you go back through the history, the Saudi Arabia has lots of discipline. When they say they're going to do something, they can do it. Pretty much nobody else in OPEC has any discipline. So, it's going to be very interesting as we look through the next 3 or 4 months to see how that plays out. But that's the battle of the swing producer. OPEC lowers production, prices go up a little. The shale oil people add their rigs, they add their risk management, and we're stuck in the trading range. And then inventories can take us out of that range if they get drawn down really fast or if they build up too fast. So you've got these 3 sources of surprise, and then all of those things are kind of laid on top of the weather. It has been awesomely cold in Europe and not so cold in the United States. So you're getting some different aspects of how the fuel is going to get used and how these things are going to play out. But I think we're stuck in these trading ranges until inventories, production, or OPEC takes us out of it. And you're looking at it, you're nervous about it, but it hasn't happened yet. But from the perspective that I'm looking at, it'll be unusual if OPEC discipline holds through 2017. I'd be very surprised if U.S. production doesn't really take off again to the upside. So I don't think we're going to stay in these ranges, but that's what we're looking at. We're looking at these scenarios and giving them probabilities.
Yeah, so again, and I always like listening to what you have to say because, Mark and I tend to look at the numbers because there's a lot of things that we got to try to, keep an eye out for during the week. But the fundamentals are where I generally lack the information. But it's always a pleasure to get what the fundamentals are supposed to tell us. So, given what you said, I have one statement and then just another question for you in terms of the shale oil business. Given what you said, that would play well into the bias that we're seeing from a skew standpoint, right? Because everything you said in terms of the discipline and the shale production and that type of thing would at least lead me to conject that the pressure is on the downside. So that makes sense that the put side is still bid quite a bit, and we're seeing the negative increase in the skew. But as far as the shale oil, sorry.
You're right about the skew there. The market is pricing it at whatever it is today. That's what's balanced the market. But if you look at where the fears are, That is where if you're a hedger or if you're a trader or whatever, you come at this, you're looking at what could surprise me. Your list of surprises that might take you to a lower price range is longer than your list of things that could take you to a higher price range. So to me, that's why you've got this bias in terms of more put volume than call volume and things like that. But the market's clearing at today's price, so that we've balanced out the expectations. It's where you're putting the probabilities on the surprises that works out in the extremes, and of course that's where options really help you manage that risk.
Blue, this is, I think you alluded to it earlier, but this is the first time we've had you on since that big OPEC day. It sounds like you're not buying what OPEC's selling. You think that this cut doesn't sound like you think it's going to really hold true in the long term. You think Saudi Arabia has a discipline, but the rest of that prisoner's dilemma that is OPEC, the rest of them are going to cave under the pressure. Is that what you're thinking?
Well, if you look at all the OPEC countries plus a few non-OPEC countries that are, associated with OPEC, every one of them is in a situation right now where they really need the cash flow. They a couple of years back, they were planning their budgets on $80, $100 oil. It's sitting, at half that. And so they need the money, and it's hurting them. So if you shut down production or cut it back, you cut back cash flow into that country. And so, it's just going to be, to me, it's a matter of time on which countries peel off first. But if you're a Venezuela, you're a Nigeria, you're an Iran, you're an Iraq, you're going to want the cash. So at some point, you're going to talk to Saudi Arabia and say, I did my best, but I need the money. Even the Saudis need the money, but they're rearranging their economy, and they're going to go to the debt markets and borrow some, so they can have a little more discipline. The interesting thing statistically, though, is the correlation between OPEC production and the price of oil has gotten a lot weaker since around 2007 or 8, and that really corresponds to the production boom in the United States. So this is back to that battle of the swing producers. So even if the Saudis maintain the discipline of the past, their influence is not, or OPEC's influence is much, much lower than it used to be, given that now there's a possibility of another swing producer, and in particular one that's incentivized by the market, so it works in the opposite direction. And if you couple that with the ability to lock in a profit on a well that's only going to run for 18 months or 2 years, we should see faster production swings up and down as the price moves. So we're in a totally different environment from how OPEC used to influence markets, and that's what's got people, a little bit nervous about. We're in the trading range, okay, but I'm afraid. That's where they're coming at this.
Yeah, it's certainly understandable. You're right. You have a lot of regimes out there, Saudis aside, who they can't afford to turn that spigot off. Their entire economies are reliant on that flow of cash coming in, even at relatively lower levels for Brent and WTI out there. They still need to hit that bid as often as possible. So the notion of relying on them to take that step and turn the spigot off, or at least turn it down a bit, I'm kind of with you, Blue. I don't think I have a lot of long-term faith in that level, which maybe not so good for crude bulls, but if you're a bear out there, one of the many people out there who seem to be loading up on puts in the long term, maybe that puts a smile on your face. Speaking of putting piles on people's faces, Blue, this is the portion of the show where Nick and I usually put a smile on a few listeners' faces answering some questions. Are you up for joining us, Blue?
Sure thing.
All right, then let's get into some futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's Mixlr.com.
All right, everybody, welcome to the Futures Options Feedback. Like the man said, this is the portion of the show where you guys get to take the reins and take us in all sorts of interesting directions. Starting off with Jeff Myers. He asks us, what's the prediction for platinum options? And I put this one in here, kind of interesting, not so much for the prediction much, but just we get a chance to talk about platinum. We don't really get to do that often on the show. And there's kind of a reason for that, listeners, and maybe Jeff may not like this, but we're digging in some of the numbers right now here and doing it before the show. And we talk a lot about gold and to a lesser degree about silver. Platinum doesn't come up on the radar that often for one pretty much predominant reason. I'm looking at the breakdown right now. You guys can do it yourselves. CMEgroup.com/Twio. Just click on metals and click on platinum right there, and you'll see exactly what I'm talking about. There's a total of 165 contracts have gone up so far this week, and the bulk of those, 161, are in the April 1050 calls. So pretty much one big trade accounted for 98% of all the volume out here, even though the overall futures were off about 10 handles out there this week. So a little bit of a move this week, but we didn't see a lot of commensurate options activity. That's pretty much in a nutshell why we don't see platinum on the show that much. It's not really a product that lights it up. So I don't know, maybe in terms of prognostication, Nick, maybe the easy bet for this is that it's probably going to be another quiet week in terms of options volume for platinum, unless you have some deep insight you've been leaning at. I haven't had a chance. Maybe we can pull up maybe while you're talking, I'll dig into some of the skew numbers a little bit. I haven't had a chance to do that yet. Any thoughts on platinum and kind of the somewhat quiet week it had out here?
You know, platinum, palladium, that whole complex of metals is very much tied to the automobile industry. So, you know, you might want to go fundamentally and kind of look at the metal and the cost of production and all that. That won't get you the right answer. You're going to really have to look at what are the automobiles industry is going to do in 2017. And the interesting thing about the automobile industry in the United States is that it's been ramping up very, very strongly over the last couple of years, and they've been extending a lot more automobile loans into the subprime arena. So if you're looking at the automobile sector and you see a slowdown in production, a slowdown in buying, then you want to flip your screen and start thinking about which way the platinum palladium sector could go. So, you know, this one to me is an economic scenario more than anything else, and very much could be in play in 2017.
Your thoughts, Mr. Nick?
Yeah, I would. Again, I'm going to defer to Blue when it comes to anything that has to do with the fundamentals around a particular product. But the thing I was going to mention, as you alluded to, you said there's not much going on, and you know that's obviously a function of the open interest in the options there as well. But you know, one thing to watch if you want to watch the platinum and you want to participate in that market, or at least keep an eye on it. You know, the CME offered a few months ago, I believe it started the gold platinum spread futures contract. So that could give you an opportunity to pay attention to both markets, and then you know, possibly see your opportunities to trade that spread, because that thing has historically moved around in some very wide ranges. So if you are bent on taking a look at platinum and at least keeping an eye on it, you probably look at the spread, and you have an opportunity to both look at the outrights as well as the new contract that's available. And I don't know if there's a tremendous amount or open interest in there. I checked the other day to look and see, but you know, it is something to watch, because it will give you an opportunity to take advantage of both, and then you can start to look at the fundamentals from both sides, from both the gold and the platinum side.
Yeah, it's not a bad starting point, because a lot of our listeners, I think, have a better handle on gold than they do on platinum. So maybe rather than just diving whole hog into platinum, they get a little bit of they get to apply some of their gold knowledge, and then see how it relates to platinum, and kind of maybe get going from there. Maybe that's a little bit less intimidating than just trying to dive into this product that trades, you know, esoterically at best, and driven driven by a lot of interesting fundamental mechanics and factors, as Blue pointed out, including the automobile industry, and you have to have a good handle on that to really get a handle on this product. But great question. That's why we like to have you guys ask these questions, because you draw us into products that maybe don't normally make it onto our radar, at least, or we have time to fit in on the show. All right, speaking of products we have to fit in, everybody's got questions about crude, including Eddy. He says, is the trade in crude options right now, is it more cautious, or are the bulls all in? Is this the period we've been waiting for? This is kind of funny, Nick. This kind of reminds me of what you and I were chatting about a lot on this program last year, particularly as week after week we were kind of documenting the skew out in WTI, and it was kind of all puts all the time. The calls had just no life whatsoever and we were waiting for that inflection point. When was it going to come? When was it going to come? It seems like that inflection point was the big OPEC meeting in November. That's when the bulls roared to life. The calls, particularly in the near-term portion of the skew, roared to life, at least compared to where they were most of 2016. So it was very much, if there was an inflection point I could point to back last year, I think that was definitely it. Our questions about the long-term prospects of that cut notwithstanding, a lot of the market dove in pretty quickly and was pretty strong. WTI rallied, obviously, as a result. We've seen a little bit of vacillation since then. Long-term, the puts are still leading the calls, the charge. So, and I don't think we can say that the bulls are all in. If that was the case, we'd see, I think, clearly that reflected in the volatility skew. We'd see calls at the very least on an even keel with the puts, if not outpacing them to the upside. That is not something that we have seen of yet. We see more life in the calls, but they're not leading the party or leading the dance as of yet. I don't know. Would you agree, Mr. Nick, or you think the bulls are all in?
Well, I think, we can go back to what Blue said earlier probably, and I'll let him jump in here. Just in terms of it doesn't sound like the bulls are all in. And I think if we reiterate the point, Blue, you want to reiterate your point again? I think we almost answered this question as part of when you were educating us on the fundamentals.
Yeah, no, the bulls are definitely not all in. This is a balanced market for now, much more than it has been over the past, because you can make cases that the economy is going to get stronger, that the U.S. economy gets stronger, people drive more. And by the way, there's been a lot of increased volume activity in the gasoline contracts, RBOB, as we say. So you can make a good case for the upside, even if you're fearing that the OPEC deal collapses or the shale producers come online. So that this is a balanced market that's waiting for a surprise or some new fundamental to come hit it. It's not a market that's, as some people would say, oversold or overbought. It's solidly in the middle of its trading range, waiting on something to happen.
Yeah, I think the options we're looking at here, and the open interest in the volume, the skew, tend to bear that out. Calls more love, but not really an explosion. The puts leading the dance, but the puts aren't really as prominent as they were either. So I think a nice middle ground here, like kind of what Nick was alluding to earlier, volatility as well, kind of waiting for that next development to really break out in one direction or the other. Any other thoughts on WTI, Nick?
Yeah, well, we always try to throw out, not that we're recommending anything, but we, in a market that's sort of trending with the potential for some a direction to move one side or another, right? You always can think of getting along those wings and selling that at the money, to get on an iron fly, maybe to sit around and catch some of the decay that's occurring at the money, and then put yourself in a position to make up for something on a move up or down. So like we mentioned, when the vol gets cheap, right, and you're at the low end of a range, we always talk about buying puts and buying futures. But if we're going to sit in the trading range here, and you want to get in the option market, that might be a good opportunity. Selling a call spread, selling a put spread, and sitting on those wings that might balance out from a volatility level standpoint, even though the puts are bid. You have a generally equal average volatility, and then get some decay if there's a continued range trading in the crude itself.
All right, and last up here, I think this is right up your alley here, Blue. I think you'll like this one. This comes from Sean. He's asking about FX. I haven't talked about FX in a little bit, but a good time to talk FX, given, of course, Inauguration Day and a lot of talk about international tariffs and domestic tariffs and everything else. And a lot of that, of course, plays out in the currency markets. And Sean asking us, when it comes to currency options, is there one particular market that trades more smoothly? I'm going to maybe swap out smoothly with more liquid. That might be maybe a better way to describe it. But it's clear there are a few leaders out here, Blue. So what do you have to say for our friend Sean, who's looking for what he terms smoothly? I'm going to term the most liquid, currency options market out there.
Well, the liquidity is definitely in the euro against the U.S. dollar, the yen against the U.S. dollar, and there's pretty good liquidity in things like British pound and others. But, it's the big ones that have the most liquidity. And the interesting thing about that liquidity is it's through the whole day and night. I mean, this is a 24-hour situation. We had interesting thing go on with the UK in the past week where, there were rumors that the Prime Minister was going to change her position and make a speech about a hard Brexit, a very abrupt leaving of the European Union, and the pound went down in the nighttime hours in the U.S. and then it came right back up. So there's one of the beautiful things about the foreign exchange market and the liquidity that's available in these bigger currencies is that you really can trade them any time of the day or night. But anyway, the smoothest, the most liquids are going to be your biggest ones. But that doesn't mean you can't get liquidity and you can't get trades done in the lesser markets. Certainly, one of the markets that's been in play around the election and will continue to be in play is the Mexican peso. Just because it was a campaign issue and it's out there and people are concerned about it, they're looking at it. So, that would be not as liquid a market as the big ones, but there's still some activity there and you can get trades done.
Yeah, I was looking at some of the numbers while you were talking, Blue, and you're right, it is a clear winner here for the Euro USD. That does the most volume. Open interest at about 100,000 contracts. Average volume in a week about anywhere from like 40 to 60 thousand, depending on the week. So that's where you're going to see the lion's share of the activity. The 1.06 puts out there in the front month leading the charge this week with about 2,700 contracts. So you're going to see some decent volume. You're going to see some decent activity out there. Then it drops off a bit. You're going to see probably names like Pound USD. They also do pretty decent numbers, but a lot less than what we're just talking about. Open interest, about half that, about 53,000 contracts. ADV or weekly volume, somewhere in the 16 to a 20-odd thousand contract range, depending on the week. And the big trade out here this week, the 1.23 puts in the front month with about 1,600 contracts. Then it kind of scales on down from there. So if you're looking for what you term smooth, I will term liquid. You got to go Euro USD. That's kind of the easiest starting point. Probably the easiest for you. You don't mention your level of currency experience, but if you're new to currencies, I'd imagine that's one of the products that's the easiest to kind of wrap your head around intuitively as well. And then you can start maybe going on from there. Getting some of the more esoteric, less liquid, less volume heavy products out there in the FX space. And then you start getting super high end. You start getting into double and triple crosses and all sorts of fun stuff. But we'll save that for another day. Mr. Nick, anything here on the currencies before we wrap up here for today, sir?
I've got one more on the currencies.
Oh, go for it, Blue.
One of the interesting things about currencies as we look into 2017, but particularly that euro that you were mentioning where a lot of the liquidity is the event risk coming from elections. The French are going to elect a new president, and they have 2 rounds of elections, but April 23rd and May 7th are the dates that you have to watch for there. And there's going to be a lot of activity around the euro associated with that election. And then in Germany, they haven't set the date yet, but their parliament, their Bundestag, will get reelected, or there'll be a vote, and that vote will either come in September or October. In the next couple of months, they'll tell us the date, and we can focus on that. But both of those elections, the French one and the German one, really put the euro in play as following on from the surprise of 2016 with the UK vote to leave. And so the issue is how strong are these nationalistic party is going to be. And in France, we think they're going to be pretty strong. So, we're going to have an exciting year in the euro, and it's going to come from political event risk.
Nick, last word to you, sir. What do you have to say for our friend here, Sean, looking to dip his toe into the currency options markets?
No, probably not going to add anything new here other than what you guys mentioned. Again, when you're talking about, as you mentioned early on right away, when you're talking about more smoothly, that means, to me, that means where there is liquidity available to you, so you can trade on the spread on the reasonable levels. And again, it's going to go to the three majors in terms of the euro, the pound, and the yen. Those others are getting more and more active and available. But when you look at pure open interest numbers and expirations and weekly activity, all that kind of thing, those are the ones you want to that you want to pay attention to going forward. And then, to Blue's point with the political risk trade and all that kind of thing, and anything that's going on in the outside of the U.S., you have the ability to trade those weekly options in the currencies as well. So you get some really active expirations in terms of being able to capture movement with the possibility of not spending that much premium. So in particular, in those three currencies we mentioned, take a look at the weeklies, and you really should be able to cover a pretty short time frame as well as a midterm time frame in some of your trading decisions.
All right, that's going to do it for the futures options feedback segment. It's also going to do it, unfortunately, for this episode of TWIFO. There's the music. That's what we were waiting for. Can't wrap up the show without that funky tune. But before we go, as always, let me check back in with my cohorts here, my partners in crime on the old TWIFO program. Let's start with you and our CME guest hot seat there, Mr. Blue. You guys are always working on interesting research papers over there. I mentioned your colleague Eric's piece coming up, or just released actually, on crude. What else do you guys have in the hopper? And if our listeners are interested, they want to read more of your research, where should they go? What should they do?
Well, they can definitely go to our website to see the research. The latest piece that just came out was on equity markets, and it looks at what's going on in the sectors, which are very, very interesting in this highly politicized year. So we are really drilling down into the changes in fiscal policy, which sectors are going to be winners and losers, and how that's going to affect volatility in the equity market. So that's where we're headed.
There you go. Head on over to cmegroup.com. And you can find the research on their tabs, or just search for Blue Putnam or Eric Northland, his colleague there, and you'll find a lot of those reports. It's quite a bit. I was scrolling through it during the show. It's quite a bit to read there. So if you want to get into all of the underlying underpinnings of a lot of these products and a lot of the fundamental factors that are driving a lot of the options flow we're talking about here on the show, check it out. Mr. Nick, you guys are always working on interesting new updates and widgets and tools over there in the realm of QuikStrike. What can we look forward to in the coming weeks, sir?
Well, to Blue's point, this week, the end of this week, I think the CME is promoting the ability to utilize sector futures as part of their equity total cost analysis tool. So what that will allow you to do is take a look and see how futures can save you money against the ETFs that you might be trading to cover those same sectors. So that got released the middle of this week. So that's a tool that's already been out there, the equity total cost analysis tool, but it only worked for the S&Ps. Now it's going to be available for those E-mini sectors going forward. As far as other things going on, I mentioned early on that there's a new way to look at the open interest and the open interest profile tool. But I think the big one for this week is that starting Monday, CME Direct, it will have embedded QuikStrike windowing available within the application. So now you'll be able to click on a strike in CME Direct and have it tie and update a window that's right inside CME Direct. You'll be able to do that for pricing sheets, trade builders, volatility curves, block trade analysis, all that kind of thing. So the integration has gotten that much more refined with this latest release. And again, that's scheduled for January 22nd. So take a look. And we'll also be creating some new tools out on the CME website. Look for a nice expiration calendar, which will give you the ability to take a look and see what expirations are trading around particular dates, as well as what economic indicators might be close to those same dates. And Some new scanning tools are out there. So, keep an eye out. Visit the website. Visit cmegroup.com/TWIO to see what we did today, and take a look at the open interest profile tool, because we're always sort of pushing those tools forward.
There you go. Check it out, cmegroup.com/TWIO. And on behalf of Mr. Nick and Mr. Blue, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing. And of course, for all of you hardy souls who pulled yourself away from Inauguration Day coverage to join us in the chat room. We love you guys too. And we'll see you next week for more of This Week in Futures Options.
This Week in Futures Options is brought to you by QuikStrike, options pricing and analysis software. QuikStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuikStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuikStrike is the perfect addition to your trading toolkit. Learn more about QuikStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuikStrike1. That's QuikStrike1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.